On Business Incorporated today, Africa Finance Corporation launches $2 billion fund to support Africa's economic recovery. In South Africa to receive $547 million from Global Fund to tackle HIV, tuberculosis. And Ethio Telecom launches 5G trial in Addis Ababa. Hello and welcome to the program. I'm Will Iban. We begin the show with market numbers we track here in Africa, which were mostly negative at intraday. Nigeria's main index was the only gainer. It rose by 0.36%, continues yesterday's bullish move, while South Africa's JSE fell by more than 3%. In Egypt, the EGX30 also fell by almost 2%. And meanwhile, Kenya closed positive on Wednesday. Over to the Middle East, where negative sentiments trailed intraday activities in United Arab Emirates. The Abu Dhabi index posted a 5.84% loss, while Dubai's main index was also down by a similar margin. Elsewhere in the region, the Qatari index was down 2.43%, while Saudi Arabia's market also dropped by 2.83%. Now to Europe, where European stocks fell sharply on Thursday as global markets digested the latest inflation reading out of the United States. The reading has sparked concerns that a path of aggressive rate hiking lies ahead. Chelsea Delaney joins us from Berlin. Hi, Chelsea. The meltdown in cryptocurrencies has shaken markets around the world, including Europe. How exposed are investors in Europe to cryptos?
Well, Europe was historically not the biggest market for crypto investment. That was more the purview of the U.S. or markets in Asia. But that definitely did change during the retail trading boom of the pandemic. And now most retail trading apps like eToro do offer Bitcoin and other cryptos. In 2021, according to the ECB, around 10% of Europeans were invested in crypto assets. That sounds a bit low, but it's actually not too far off from the 16% of Americans that are invested in crypto. But it's also a trend that started to spread to the big money, institutional investors. Last year, for example, Germany said institutional investors can allocate about 20% of their assets to crypto. That would equate to about $415 billion. It's unclear how much of that they actually put into crypto assets, but it's clearly a trend that's starting to take over mainstream finance. But I think this recent sell-off will remind investors that it remains a very volatile asset.
Now, European corporate bonds have also been hit hard by the recent market sell-off. Now, seeing the sharpest pullback in the latest 20 years, at least 20 years, pardon me. How is this impacting EU investors and companies?
I mean, clearly it's getting harder and harder for companies to borrow money, and that has really sweeping implications. One index of EU high-grade corporate bonds, so these are the bonds seen as the safest from the most stable companies. They've seen a sell-off of about 10% this year. That's the biggest sell-offs they've had on record. Junk bonds, which are even riskier, have been hit even harder, and that means that yields are going up and companies are having to pay a lot more to investors to borrow money. And this trend, like the crypto sell-offs, like the stock sell-offs we're seeing, it's largely being driven by inflation and the fact that central banks are starting to pull back on the emergency stimulus of the pandemic. In this case, it's going to hit European companies and their bonds quite hard because the ECB has been buying corporate bonds, hundreds of billions of them, and they're effectively subsidizing the borrowing of companies. That's coming to an end, and that's why we're starting to see investors start to get really spooked about what this means for the health of these companies. So far, we haven't seen, a wave of companies defaulting on their debts, but that is something that investors are aware of and are wary of, especially for companies that are more financially distressed and vulnerable.
Well, we look at Russia has imposed sanctions on 31 European companies in response to a looming gas embargo by the West. Will this further pressure gas supply to Europe?
Yeah, investors definitely seem to think so, and that's driven up EU natural gas prices by more than 10% today. Essentially, Russia has made it illegal for state-owned gas giant Gazprom to sell or transact or to send gas to these 31 sanctioned companies. And on that list are really a lot of the key EU energy suppliers, including the operator of the Polish part of the gas pipeline Yamal. That's a key thoroughway for gas coming from Russia to the EU. As well, on that list is the German subsidiary of Russian oil giant Gazprom that was taken over by the German government recently. The German economy minister, Robert Habeck, did say this morning that gas flows to that German subsidiary have stopped, but they were able to find other suppliers. It's unclear at this point if this is the moment in which Russia cuts off gas to Germany like it's already done to Poland or Bulgaria. And experts do say that there could be workarounds from the sanctions list that Russia has imposed, that some companies could found new subsidiaries that aren't on the sanctions list. And of course, they also note that Russia is very dependent on gas revenues, Germany being one of its biggest customers. So they say this could turn out to be bluffing. But if Russia does follow through on this, if it does start to cut off gas to Germany and other European nations, like it's already done to Poland and Bulgaria, it would be a huge blow to the economy. EU countries had been making plans to be independent of Russian gas, but not for years, not until potentially 2028. So they certainly aren't ready for that yet.
Thanks, Juliana. Thanks, Chelsea, for that update. We'll keep watching that. So we move over to London, where the gas windfall tax is still evolving, and Juliana is standing by with updates. Hi, Juliana.
Hi, Will.
Juliana, you were talking earlier, you've been talking about the windfall tax, and now we hear that Prime Minister Boris Johnson has refused to rule out windfall tax. What else are you hearing about this?
Yeah, this is a really interesting conversation that appears to be growing legs in all different areas. The windfall tax is a one-off levy that the UK government would put on companies that have profited during the COVID-19 pandemic, in particular the oil and gas giants, because a couple of weeks ago, BP reported £5 billion worth of profit in the first 3 months of this year. And Shell, too, had a whopping £7.2 billion worth of profit. That profit comes at a time when we know, because we've discussed it extensively, that the cost of living crisis is starting to bite. Earlier this morning, Will, the Office for National Statistics released data showing that the British economy is shrinking. And because we didn't hear much in the Queen's speech about how the government are going to tackle the cost of living crisis, opposition MPs, as well as charity groups, including John Allen, who's the chairman of Tesco, Britain's largest grocer, they're saying, well, why would you not put a windfall tax? Previously, the British government said they didn't want to do it because they believed if they did it, a lot of these companies that pump money and investment into Britain would want to go elsewhere. But that argument was shut down because Bernard Looney, in an interview with The Times, Bernard Looney is the CEO of BP, he said that he would pay a windfall tax and that wouldn't deter investment. So now the Chancellor and the Prime Minister have been backed into a corner, which is why the Prime Minister this morning said he wouldn't rule it out. So we just have to wait and see. But again, it's a conversation that is growing legs, and perhaps, imposing this windfall tax on these firms would help the 1.5 million households who are struggling to pay their bills and put food on the table at the moment.
That's really hard to chew, especially with Brexit and the fact that the UK needs to keep its investors. This is going to be very, very hard topic, especially subject matter to discuss. I can just imagine now. But yesterday, we saw the first meeting by a dedicated group for creating UK green job opportunities. What's this about?
Yes, well, this is all about Britain's race to net zero, which they want to achieve by 2050. Boris Johnson's government have really been trying to do whatever they can to grow the green economy. And by doing so, they would make sure that people up and down this country have the right skills and, of course, there being the right investment. So a new scheme was launched yesterday called the Green Jobs Delivery Act. Act. And what this group will be trying to do over the next few years is support 480,000 skilled jobs in the green economy by 2030. It's a big feat, but definitely it's something the government need to do. And it's all part of this levelling up agenda as well, where the government are trying to take lots of money and investment that's always in the southeast and in London here in the capital and pump it up into the north, who Boris Johnson is trying to appease that part of the country at the moment. And by doing so, there'll be big investment projects, but they will all be about achieving this net zero transition and ambition from the British government. So that's 480,000 jobs under the Green Jobs Delivery Group Act. Their first meeting was yesterday, and it was chaired by the Energy Minister.
Interesting conversation there. Now talking about pumping money into the market and appeasing the market. I hope the market is looking good. How's the market looking today, Juliana?
Well, not looking great, actually. No surprises, really, because of that pretty abysmal data we got from the ONS about the UK economy showing it's shrinking faster than economists and even the Bank of England had projected. The FTSE All-Share and intraday, Will, is down 1.93%. The FTSE 100, that's down by 1.97%. And the FTSE 250 is down by 1.73%. Now, in the currencies market, the British pound is down on the US dollar too by 0.49%, but up on the euro by 0.60%. But down on the Japanese yen and intraday by 1.60%, Will.
We hope to see an end to these global rout, but pretty soon, Juliana. So thank you so much for coming on. Always good to have you.
Thank you.
Now, shares in Asia Pacific were lower on Thursday as tech stocks sold off following overnight losses on Wall Street after data showed the consumer price index stateside in April remaining near the highest level in more than 40 years. In Hong Kong, the Hang Seng Tech Index declined by 3.84% to 3,864.95 points. Technology stocks in Taiwan also saw losses, with Taiwan Semiconductor Manufacturing Company shares sliding 3.07%, while Pentagon fell 1.17%. In the broader market, Hong Kong's Hang Seng fell 2.24% to close, while the TAIEX in Taiwan declined 2.43% on the day to 15,616.68 points. Mainland Chinese stocks shed earlier gains, with the Shanghai Composite closing 0.12% lower and the Shenzhen Composite falling 0.13%. The Nikkei 225 in Japan fell 1.77%, closing at 25,748.72 points, while the Topix Index shed 1.19%. In South Korea, the Kospi closed 1.63% lower. Australian stocks also declined as the S&P ASX 200 dipped 1.75% to end its trading day. Now we'll take a quick moment. When we'll be back, we'll take commodities update next. Do stay with us. Welcome back. 5 of the fastest growing cities in the world are in Nigeria. For example, many people living in Lagos can testify of the hours spent in traffic on a daily basis. As a result, more people are patronizing fast food outlets due to a lack of time and energy to prepare their meals. A burger from Nigerian fast food brand costs anywhere between 2,200 and 6,000 naira. We have Olufunto Ajenifuja, analyst at financial derivatives company, to discuss this with us. Hi, Funto. Good to have you.
Hi, thank you for having me.
So, does this shift to fast food alternatives look like a sustainable trend for you in the country, seeing the economic situation we are in?
Okay, so it's true that Nigeria has some of the fastest growing cities in the world. So what does this mean? This means congestion, this means traffic. And, you know, those of us living in Lagos, we know how long we spend. The last thing you want to do is go home and gather your ingredients and make a meal. So we're seeing that more people are shifting to ordering fast food items. And this is because people value convenience. And, you know, with the situation going on in Nigeria, demand is shifting to fast food because not a lot of people have the money to go and sit down at a proper restaurant and spend, you know, 15K, 20K for a sit-down meal. So this trend is definitely continuous. We don't see this dying anytime soon because, you know, there's a strong population growth, especially of the young and, you know, especially in the urban areas, the young urban dwellers, they're increasing, and they value convenience. So, yeah.
Talking about value convenience, it's still not convenience of the pocket as well, because I hear that a bottle of Coke now is about 300 naira in a restaurant. So how would the ordinary Nigerian who values convenience be able to conveniently pay for that? Now, how do you think that's going to happen?
So I'm talking more about people that, earn a decent income in Nigeria. I feel like even though the prices of these things...
So this is for a certain demographic. You're not talking about most Nigerians, the average Nigerian.
Yes, I'm talking about a certain demographic, the young, the urban, in the elite areas
Possibly
as well.
The elite.
Yes, young bachelors that, that are earning a certain amount of money, they are more likely to go home ordering a takeout meal as opposed to cooking. So, yes.
So is this cost rally, is it happening globally? Is it just a thing in Nigeria?
Okay, so this cost rally that's happening globally, I'm going to use something for us to paint a picture of this. So according to the CNBC, the Big Mac burger is a powerful demonstrator of how inflation is affecting Americans. And the price of a Big Mac is about $6.05. Which has gone up even more than the rising cost of living, which has gone up 38% in a decade. So that paints the picture globally. So now, domestically, it's not uncommon to see a lot of these foreign fast food outlets set up shop and not stay. And this is due to a number of reasons, but a key reason is the quality of inputs, being able to source quality inputs here. So this means that a lot of them have to import their ingredients, and imported inflation, that is going to be incredibly expensive now. When you break down a burger, you have the bun, you have the beef, you have, and it's incredibly detrimental for a brand, for a customer to go in, get a tummy ache, or it not taste good. Someone tweets about it. That paints a terrible picture of the brand. So that is a major fear for a lot of fast food outlets that want to set up shop in Nigeria. Another thing to consider is the health consciousness that is happening globally, that we're now seeing domestically. People are becoming more health conscious. Things like burgers and pizza, they're not necessarily healthy. So that's another thing to consider. Even though Nigeria is experiencing a strong population growth, even though there is a change in the consumer taste, a shift in the way people are, in what type of food people are choosing to eat.
So do you think it's a viable market for Nigeria?
I do think it is, yes, because the demand is there.
Okay.
The demand is there. It's just that there are certain things such as being able to source quality inputs, health consciousness, that brands have to consider.
So how has this new trend affected process and costs in the country, basically, to acquire quality inputs in Nigeria?
Okay, so as I kind of touched on in my last answer, obviously it's not that easy to source. They can't guarantee that they're going to get the best quality. And as a brand, you want the best quality for your customer. So even though it is an issue right now, there is a business opportunity presented here for people in the domestic market to source quality inputs to these brands. Because like I said, the demand is there.
So are we sourcing locally or we're importing?
So sourcing locally. So there is an opportunity here for more, if you own a cattle ranch, more farms to get into this business, because, it's food. People need food. Fast food items like burgers and pizzas might not be a necessity. But as I said, there's an increase in young urban dwellers, so the demand is there, and these are the kind of things they would like to eat as opposed to, rice and stew, swallow, and those kind of things. So there's an opportunity.
I did see a pizza with pepper soup, flavor. So we're getting to have it more like local flavors in our. So is this going to be a trend? Is this what people are now trying to see? Is the taste people are beginning to acquire for, and then is the market for it?
Yes, there's a market for it. And like I said, there is a way you can. So especially if we source, for instance, if you source, when we look at the cost of beef right now, and you look at meat in general, because obviously burgers, you can have a chicken burger, you can have a fish burger, you can have a beef burger, and chicken is pretty much a luxury meat now, even domestically. So imagine having to import that as well. So there is a massive opportunity for, people to be able, if people are able to source the same type of quality locally, then, more businesses will be setting up shop here.
Thank you so much, Olufunto Ajefinija, for coming on the program and sharing your thoughts and perspective on the fast food market. And I hope that many Nigerians maybe log into this and probably have money to buy. So thank you so much for coming.
Thank you for having me.
Moving on to other stories, Africa Finance Corporation is launching a $2 billion facility to support recovery and resilience in Africa. This is in response to economic challenges created by the global pandemic and the Russia-Ukraine crisis. AFC is committed to funding up to 50% of the new African Economic Resilience Facility and mobilizing the remainder through corporation's network of international partners and investors. South Africa's government is set to sign today a grant agreement for $547 million with the Global Fund, a donor organization that tackles AIDS, tuberculosis, and malaria. The money will be used to fund the government's AIDS and TB programs and will cover the period from April this year until March 2025. In February, 5 African presidents joined other world leaders to launch the Global Fund's $18 billion campaign to restore progress against AIDS, tuberculosis, and malaria amid the COVID-19 disruption. Now, the Ethiopian state-owned operator Ethio Telecom has launched its first 5G base stations in the nation's capital, Addis Ababa. Ethio Telecom says the 5G service is expected to provide customers with best-in-class solutions, boost productivity, as well as introduce new solutions to customers. It adds that the rollout will also impact industries that have mission-critical services needing real-time decisions, such as manufacturing plants, remote healthcare, precision agriculture, self-driving vehicles, and the Internet of Things. Now, stock futures traded lower Thursday morning as the sell-off continues on Wall Street that pushed the S&P 500 to the lowest in more than a year and to the cups of a bear market. The futures tied to the Dow Jones Industrial Average set 118 points following 5 straight days of losses. S&P 500 futures declined 0.5% after the benchmark closed at its lowest level since March 2021 in the prior session. Nasdaq 100 futures declined 0.9% as tech shares continue to be at the epicenter of the selling during the risk-off period. The latest inflation data yesterday showed consumer prices in April jumped 8.3%, higher than expected and still running close to a 40-year high of 8.5%. The report caused investors to continue to sell risky assets like tech stocks and Bitcoin. And that's it on the program. I'm Will Ibang. Thanks for watching.